Oh, yeah, time for Chart Attack. You know that music. All right, today we're going to talk about a group of stocks, and when they go down, not necessarily bad for the market, might actually be a good thing. Kind of curious, huh? All right, we're joined by Michael Gayed. He is Chief Investment Strategist at Pension Partners. Michael, this one's kind of got me curious. You're looking at utilities versus the Dow Industrials.
Right, so I know everyone focuses on Dow Transport's Dow theory. I think actually utilities are more important. So what we have here is a price ratio of the Dow Utilities ETF, IDU, divided by the Dow Industrials, DIA. A rising ratio means utilities are outperforming, up more or down less, the Dow Jones Industrial Average. Now, look at how the trend is well defined here. Generally, when utilities underperform, it means investors are feeling more comfortable with risk. That's because utilities have a lower beta.
And they're running to utilities, in theory, for yield or because they're scared.
Right, exactly right. So it tends to be kind of the defensive sector of choice for most equity-only managers. Now, in 2009, you can see that the trend was fairly defined on the downside for the utilities Dow ratio. That was a very good environment for stocks. Obviously, we had the huge rally. In 2010.
So in other words, as we had that big rally in 2009, people were coming out of utilities, going into riskier names, so that ratio came down. Utilities fell relative to the S&P.
Correct.
Or the Dow Industrials.
Correct. Now, the ratio actually bottomed in mid-April before the May 6th flash crash of 2010.
And then it rallied.
And bonds and anything dividend-oriented did quite well. The peak coincided with talk of QE2 from the Federal Reserve.
So wait a minute. So post-flash crash, people got scared again, so they got defensive, started buying stocks like utilities, so that ratio went up. Then QE2, the government said, hey, we're putting more money in. Say, whoa, I don't want to be defensive. I want to get me some assets.
Right, exactly right. And notice how defined the trend is. Again, this is a key to this ratio. Now, following the QE2-infused rally, you saw the Europe scare start to happen. You started to see last year utilities start to outperform. You see that the ratio really spiked up in August, September, the summer crash of last year.
And here we are right now, the 212 rally. That thing is going down, which in theory means the market can keep going. But also, if you look at that chart, every time we've gotten this low and the ratio is that low, it turns. So is that telling us maybe it's time to get defensive again?
There's an element of that, but the trend is still going down. And let's be clear, the reason that this week in particular there's a sharp drop was this financials news. This was very much a game changer for the bulls. For the financials now to be able to say we're going to increase dividends, that's direct competition for utilities. That's competition for anything safe-oriented.
Okay, Michael Gayed, Pension Partners, thanks for explaining. When utilities go down, good for the market, Trish.